All right, let's dive right into this explainer. Today, we are unpacking a massive valuation mystery surrounding Option Care Health, or OPCH. We're going to figure out if its recent, frankly brutal, stock plunge is a generational value opportunity or a blaring red warning sign. It's really rare to see a company with a long-term track record of explosive growth just suddenly face this level of intense market punishment. So, we're going to strip away the noise and look strictly at the raw data. We'll pull apart the revenue, the margins, the cash flow, and those crucial valuation multiples to see exactly what the market is pricing in right now.
To solve this mystery without getting lost in the weeds, we'll follow this exact roadmap, starting with the big price drop, comparing revenue versus earnings, checking the financial health, evaluating the key ratios, and finally, revealing the true intrinsic value.
Okay, part 1, the big price drop, blood in the streets. Let's set the stage and look at the sheer magnitude of this sell-off. Just look at the staggering number, negative 46.96%. Option Care Health is currently trading nearly 47% below its 52-week high of $36.80. For a multi-billion-dollar healthcare company, taking a haircut of that size usually implies something is fundamentally broken, like a massive earnings miss or just a total drastic shift in market sentiment. And this illustrates that horrific recent momentum perfectly. The stock is just systematically bled out over the past week, month, and year to date. Notice that sharp 31% drop over just the last 30 days? That is heavily dragging down the trailing 12-month return to negative 39%. The market is aggressively, almost in a panic, repricing this asset downwards. But why?
That brings us to Section 2, Growth, Revenue versus Earnings, and Finding the Friction. Let's see if the underlying business is actually failing.
So, the crucial point here is the contrast. When you look at top-line revenue growth, it remains incredibly steady, holding at around 9.3% for the trailing 12 months. That's pretty close to its 5-year average of about 12.9%. But, and this is a massive but, we are seeing an alarming slowdown in trailing 12-month free cash flow. Plus, EPS growth has decelerated sharply from a historical 82% down to barely above 2% recently. Basically, the top line is expanding, but the actual cash flowing into the company's pockets, it's evaporating. This head-to-head comparison highlights the absolute core of our mystery. We have a company with historically explosive earnings growth that has suddenly hit a severe cash flow roadblock. A negative 38% drop in trailing 12-month free cash flow. That is exactly the kind of metric that triggers institutional panic selling. Investors buy growth stocks for future cash flows, right? So when that cash flow suddenly contracts this aggressively, the market pulls the ripcord. Section 3, Financial Health and Margins. Looking under the hood. Is this cash flow hiccup fatal or just a temporary squeeze?
Now, you might expect the balance sheet to be a total disaster given the stock's freefall, but actually, it's surprisingly healthy. A debt-to-equity ratio of 0.86 means they aren't dangerously over-leveraged. A current ratio of 1.64 means they have plenty of liquidity to cover short-term liabilities. And a return on invested capital approaching 10%? That shows management is still generating solid returns. The business is definitely not going bankrupt tomorrow.
However, we do see a squeeze on profitability. Current net profit margins are sitting at 3.83%, which is lower than their 5-year historical average. They're operating on fairly thin profitability ice right now. When you have thin margins, even slight increases in operating costs absolutely hammer the bottom line. And that perfectly explains why steady revenue growth is suddenly resulting in shrinking free cash flow. Moving into Section 4, Key Valuation Ratios, the Great Discount. How exactly is the market pricing this mix of healthy debt but slowing cash flow? Well, here is the potential opportunity. You are currently paying 61% less for $1 of OPCH's earnings than the average investor has over the last 5 years. A trailing PE of 15 is vastly lower than its historical norm of over 23. This is that exact repricing we talked about earlier in action. The market is officially no longer valuing this as a hypergrowth company.
And it's a sweeping discount across the board. Look at almost every traditional multiple, enterprise value to EBITDA, price to book, price to sales. The stock is trading at a massive discount to its own historical baseline. And check out that free cash flow yield at the bottom, 6.94%. That's 37% higher than the 5-year average, meaning you're actually getting far more cash generation for your investment dollar today than you would have over the last half-decade.
But hold on a second. We have to talk about this PEG ratio of 3.75. That is up 125% from its 5-year average.
It's a huge reminder that the slowing growth we saw earlier is penalizing its growth-adjusted valuation, because the PEG ratio factors in the growth rate, and since that EPS growth rate plummeted recently, the PEG ratio has completely spiked. Simply put, if you are strictly looking for rapid, compounding growth, this stock is actually quite expensive relative to its sluggish momentum.
Finally, Section 5, Intrinsic Value and Safety. The climax. It's time to put all these clues together and calculate the true intrinsic value of the business.
Real quick, before we drop the final numbers, let's talk about the DCF, or Discounted Cash Flow Model. This is the ultimate benchmark value investors use to separate a stock's actual mathematical worth from market hysteria. It basically calculates what all the future cash flows of a company are worth in today's dollars. If the market price is lower than the DCF value, boom, you have a margin of safety. So as a reminder, the market's current verdict is this closing price of just $19.52 per share. That single number represents all the fear, the margin compression, and the recent panic baked right in.
But our DCF fair value price? It comes in at a whopping $42.34. Even when we factor in the recent cash flow slowdowns we discussed, the strict mathematical value of the company's future cash generation points to a stock that should be trading significantly higher than where it sits today.
Which leads us to the grand finale. A massive 53.90% margin of safety based on free cash flow. That is a gigantic buffer for prospective investors. It literally means the stock could theoretically drop another 50% from its calculated fair value before you're actually overpaying. In modern markets, especially for a company with a structurally sound balance sheet, seeing a spread like that is incredibly rare.
So weighing the slowing cash flow on one hand against this staggering margin of safety on the other, you really have to ask yourself, is the market accurately pricing in a permanently broken business model, or are they offering you a generational 50% discount? The data clearly shows a business facing real, short-term margin pressures, yet it remains fundamentally solvent and is trading at a historic discount to its intrinsic worth. So which side of the scale carries more weight for you?